Good morning, this is Dave Toth with an RJO MRT technical webcast update on the gold and silver markets for Thursday, July 28th. Starting off here with an intraday 4-hourly chart of the full gold contract. You can see by virtue of this morning's break below this week's earlier 1607 spot 80 corrective low. The market has confirmed a bearish divergence in short-term momentum that defines yesterday's 1628 spot 80 high as the end to at least this latest portion of the secular bull trend from last week's 1581 spot 10 low. And in this regard, the technicals now squarely focus on that 1581 spot 10 low, the failure below which will confirm a bearish divergence in momentum on a larger degree and expose a much larger degree correction or reversal lower. If yesterday's and today's setback is a relatively minor corrective dip within the broader bull trend, would expect the general area of former resistance around 1605 to 1608 from last week, that since broken is now considered new near-term support to hold the market and for the market to recover to new highs. But as long as that 1628 spot 80 high remains in place as a resistant cap, traders are advised to be leery of further and possibly accelerated losses, with that 1581 spot 10 low from last week the next pivotal technical level and condition. Per this short-term weakness, looking at a 4-hourly chart of the mini gold contract, our recommended long positions from the breakout above the 1622 high from Monday have been stopped out at 1607 spot 70, moving short-term traders with tighter risk profiles back to a neutral sideline position, with strength above 1629 spot 20 required to resurrect the broader bull trend. It's interesting to note on a long-term weekly perspective, a weekly log scale perspective shown here, the market's resistance thus far to a long-term Fibonacci progression relationship at the 1630 area we've been discussing now for a couple of months. That 1630 level represents the 1.618 progression of the suspected first wave rally from way back on October 8th, the 681 low, up to that 1007 first wave high from February of 2009. The length of that multiplied by 1.618, taken from the 865 second wave low from April of that year, projects to 1630. This said, this merely derived level must be corroborated by a bearish divergence in momentum of a scale sufficient to threaten the broader bull trend, and minimally on a daily scale that level is that 1581 level we earlier discussed and we'll talk about again in a moment. It's also interesting to note that from this Fibonacci progression relationship and relative to some arguably waning upside momentum on a daily scale, it's interesting to note that the bullish consensus measure of market sentiment has recovered to an 86% level. That's the highest since November of 2009, or that accompanied that a 15% correction from a 1227 high in November of 09 to the 1044 low in February of 10 before the secular bull trend resumed. So with this as a backdrop, our attention now turns to what the market has to do on a scale sufficient to threaten the longer-term uptrend. And looking here at a daily log scale chart, you can see the developing potential for a bearish divergence in momentum as a result of the slower rate of ascent over the past week and a half. And again, the importance of that 1581 spot 10 low from last week, the break below which will confirm this divergence on a larger degree scale that would at that point be capable of exposing a much larger degree correction or reversal lower. That would be the level that longer-term traders with long-term risk profiles are advised to neutralize all bullish policy and exposure and move to a neutral sideline position. These issues considered, and in some shorter-term traders with tighter risk profiles are advised to have been advised to move to a neutral sideline position as a result of today's short-term momentum failure below 1607 spot 80. But from a longer-term perspective, we now focus squarely on that 1581 low from last week, the break of which is required to expose a much larger degree correction or reversal lower. And especially at this time where the U.S. debt ceiling crisis is coming to a head, it'd be interesting to note if the market could fail below that level, that could be an interesting ancillary indicator to positive unfoldings in that crisis, as concern over a debt crisis is what's maintained a lot of the bid to the gold market. And if the gold market starts to prove some weakness in here, we believe below a level like 1581, we believe that'd be a good indication that things are going to turn out positively with respect to the U.S. debt crisis, and also quite positively for the U.S. stock market. Similarly, looking at an intraday 4-hourly chart of the September silver market, you can see today's failure below Monday's 39.87 corrective low. That confirms a bearish divergence in short-term momentum and defines yesterday's 41 spot 46.5 high as the end to at least the past week's rally from last week's 38.21.5 low. From a longer-term perspective, however, last week's 38.21.5 low is a key to a bearish divergence in daily momentum, looking here at a daily close-only chart, that especially from the area around the 50% retrace of April-May's decline from 48.60 down to 33.50. If we get a momentum failure from the middle area of this year's range, we would then anticipate a much larger degree correction or reversal lower. Reinforcing this 38.21.5 low as a key downside pivot level on a daily log scale bar chart shown here. You can see the past week and a half or couple of weeks break above the 38.84 to 39.5 area resistance that has capped this market for a couple of months. You can also see the developing potential for a bearish divergence in momentum. If the market cannot sustain gains above that former resistance new support area between 38.80 and 39.50, and specifically below that 38.21.5 corrective low, then the market would clearly be indicating at least intermediate term, if not longer term weakness that would expose a larger degree correction or reversal lower to the past month's rally from 33.38 up to 41.46.5. These issues considered, shorter-term traders with tighter risk profiles have been advised to move to a neutral sideline position as a result of this short-term momentum failure, but longer-term players are advised to maintain a bullish policy until or unless the market fails below 38 spot 21.5, at which point moving to a neutral sideline position would be advised for that contingent as well. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.